Ladies and gentlemen, good day and welcome to Filatex India Limited's Q4 FY2024 earnings conference call. As a reminder, all participants' lines will be in listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star and then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Khushbu Gandhi from Share India Securities. Thank you, and over to you, ma'am.
Thank you. Good evening, everyone. On behalf of Share India Securities, I would like to welcome all the participants to the Q4 and FY24 earnings conference call of Filatex India Limited. We have with us from the management team, Mr. Madhusudan Bhageria, Chairman and MD, Mr. Madhav Bhageria, CFO and Joint MD, and other senior management team. We would commence the call with the opening remarks from Mr. Madhusudan Bhageria to give an overview on the company's performance. This will be followed by the question and answer. Sir, you can take over the call.
Thank you, Vishwa. Good afternoon. A warm welcome to all of you attending this conference call for the quarter Q4 ended March 2024. Joining me in this session are Mr. Madhav Bhageria, Mr. Ashok Chauhan, and Stuti Bhageria. I presume you would have gone through the investors presentation, which had been uploaded on our website as well as on the stock exchanges. Let me quickly take you through the results of this quarter, Q4 FY24 over Q3 F2024. Revenue of 1,026 crore against 1,083 crores. EBITDA stands at 64.8 crores against 74.3 crores. Profit before tax stands at 47.2 crores against 47.7 crores. Net profit is at 34.8 crores against 35.1 crore. Production was 97,000 against 103,000 and sales quantity was 96,500 against 101,000. And year on year, FY24 versus FY23, the revenue was 4,286 against 4,304. EBITDA was 239 against 232. PBT 150.4 crores against 122.1 crores. Net profit at 110.7 against 89.9. Production is 406,000 metric tons against 380,000 metric tons, and sales 401,000 against 382,000. Before elaborating on the business environment, let me give you a brief observation about the global situation over the last 5 years, which will help in understanding their impact on economy and business. The occurrence of two significant global events, namely the COVID-19 and the Russia-Ukraine conflict happening one after the other, has had a profound impact on the textile fibers market. These unprecedented events have introduced a complex set of factors that have reshaped the market's trajectory in unforeseen ways. The onset of the pandemic brought about substantial changes in consumer behavior and business operations. Lockdowns, travel restrictions, and the prevalence of remote work became the new normal, prompting business to pivot towards digital platforms. This abrupt transition heightened the importance of online presence and visibility, leading to an increased demand for effective utilization. Companies rushed to expand their online reach, resulting in a noticeable upswing in the textile fibers market, as businesses sought to optimize their online content for greater visibility and engagement. Simultaneously, the Ukraine conflict introduced an additional specter of uncertainty and volatility into the global economic landscape. Geopolitical tensions and economic sanctions had ripple effects across various industries, affecting consumer sentiment and purchasing behaviors. As businesses navigated these geopolitical challenges, the textile fibers market adapted to their evolving environment, with brands re-evaluating their marketing strategies to align with shifting consumer sentiment. Textile industry in each country evolved its own policies and recipes to mitigate the uncertainties to save lives and jobs. Overall inflationary developments across the globe and volatile geopolitical upheavals impacted the performance of textile businesses. Indian businesses have faced a rough weather in both domestic and international markets for more than 2 years. This year too, the performance of Indian polyester industry has been extremely challenging. It was a battle against Chinese imports in all forms, yarn, fabrics and made-ups. The domestic market was flooded with cheaper imports of substandard polyester yarn and fibers. Industry captains got together and fought for policy changes with facts and figures. The tidal flow of yarn stemmed only after QCOs on yarn were enforced. After the yarns issue, there was sudden spurt in fabric imports at ridiculously low prices. This too was brought to the notice of government officials who acknowledged the unscrupulous imports of fabrics at unheard of prices and put a cap of $3.50 per kg as the minimum value. Textile industry needs a level playing field at the global level. At present, Indian polyester industry is still at a significant disadvantage in competing against China. Indian manufacturers pay around $70 per metric ton more for PTA, which is short supply domestically. This being the key element of cost, it is difficult to compete with Chinese prices in domestic market, and same goes for exports. Thus, dumping on low price imports from China in all forms, yarns, fabrics, have been the biggest challenge this year. Though the domestic demand for synthetic fiber had been good, a large volume of low-cost substandard imports forced Indian manufacturers to match their price in line with import from China. A reduction of rupees 4 to 5 per kg has eroded the margin despite high volume of sales. Adding to the woes is the huge drop in exports from India, which also keep dampen margins low. Overall, at the global level, the textile fibers are growing at the rate 3% CAGR. Most of the growth at the global level for last 15 years is through polyester yarns. Polyester industry at global level is dominated by China. Last year, China produced around 40 million tons of filament at 90% capacity utilization. China had added a fresh net capacity of around 3.8 million tons in 2023. However, further expansion has slowed down. No new investments have been announced in China for 2024 and 2025. To meet this annual increase in global demand of 3 million tons, it is a good opportunity for Indian manufacturers to add new capacity. Indian capacity utilization is already close to 90% and new capacities can be added. Lack of margin has been biggest deterrent for capacity expansion. Polyester units are capital intensive. A typical melt spinning complex of 600 tons per day or 2 lakh tons annually would cost a minimum of 1,500 crores. A simple calculation for a 5-year payback would mean that at the yarn stage, the margins have to be at least 16 rupees per kg. The Government of India has recognized the dominant role of synthetic fiber in the global textile trade. The world producers and consumers have shown wide acceptance of synthetic fibers, garments and apparel. The Government of India has announced a PLI scheme for development of and boosting of fabrics and garments of man-made fibers. Clusters of mega textile parks are under planning and execution. These large parks will have the benefit of world-class amenities, which will benefit small and medium-sized companies in ready-made garments and apparel segments. Indian government and industries must evaluate and recalibrate their import strategies, fostering more diversified and resilient supply chain. Growth in imports from China has been much faster than India's overall import growth, as per a well-researched report by Global Trade Research Initiative, GTRI. Many products imported from China, such as textiles, shoes, and glassware, etc., are from categories dominated by MSMEs, and most of these items could be produced local easily. Around 2.2 million tons of PTA capacity will be commissioned at the end of calendar year 2025. These plants are being set up by IOCL, and another one is by GAIL. This will reduce the dependence on imports, which have uncertainties like shipping schedules, exchange rate fluctuation. Also, Reliance Industries is putting up a 3 million ton capacity plant for PTA, which is likely to be commissioned by 2026 calendar year end. All these factors are encouraging and will restore confidence in future of PET fibers and filament and boost domestic production. We are adding 70 tons per day capacity to produce cationic chips, which is likely to be get commissioned by May 2024 in this month. We will have an incremental margin of at least 10 rupees per kg over the regular chips. Even at 50 tons per day capacity utilization, we expect to add around 15 crores to our margin this year. Domestic demand is robust and is growing at 8% CAGR. Domestic production capacity is around 5 million tons. The new capacity addition in next 2 years will be 450,000 tons only. No other major investment is planned. With robust domestic demand, the margins that had dropped due to imports will gradually improve to a remunerative level, adequate to consider fresh capacity addition. We remain buoyant about the future of polyester filament business. Polyester is the most widely used fiber worldwide. The growth in world fiber production in the last 15 years has come from synthetic fibers only, contributing 93% of the incremental growth. Besides being very versatile, polyester fiber has a less adverse impact on environment. A comprehensive study by Swedish research company Mistra has found that it is far less resources intense to produce polyester than conventional cotton from a life cycle perspective, and the durability of polyester further improves in its environmental profile. The fashion industry is labeled as the second most polluting in the world after oil industry. The environmental footprint of a manufactured garment comprise a trail of multiple toxic processes from cotton planting, passing through processing and dyeing, and transportation to the points of sale, and finally disposal after use. Fast fashion, premised on low cost and low durability, has widened this footprint by accelerating wasteful fashion consumption. The danger of polyester clothing going to landfill is an issue being discussed globally, as polyester is not biodegradable. Considering the focus on sustainability of textile industry and the need to shift from linear to circular economy, we have developed through in-house R&D a process to utilize textile waste in any form. After extensive lab tests, we set up a pilot plant, which is now operating steadily. We are in the process of setting up a scaled-up version with capacity around 75 tons per day. This process is called chemical recycling or molecular regeneration, where material produced is of the similar quality as virgin material. Global brands, to meet their obligation under EPR, Extended Producer Responsibility, are willing to pay premiums ranging from rupees 40 to 45 crore kg for recycled products. We plan to commission our plant by December 2025. Going forward, we plan to set up such plants all over the country at places near textile hubs. This is like to be our growth model, which will be in real terms a part of the much desired circular economy and an appropriate testimony to sustainability. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Umesh Jain from Kotak. Please go ahead.
Hi, sir. Am I audible?
Yeah, you're audible.
Yeah, congratulations on a good set of numbers in a challenging environment. My question is on fabric and yarn import. While there has been an anti-dumping duty which has been levied, just wanted to understand how is the domestic business environment. You did highlight it. There has been some weakness in export given the raw material cost in India for PTA especially is slightly higher than China, and which is expected to come down as the domestic PTA capacity does come in. But especially on the domestic side, are we seeing some improvement in the margin, and sequentially can we expect improvement in the margin as we progress towards FY25?
Yeah. See, regarding the anti-dumping duty, there is no anti-dumping duty. Fabrics, yarns, the government had put a QCO. So China cannot export to India because China has not been given the QCOs. And fabric, what the government has done, the prices which was coming at very ridiculously low prices. Now the government has said that if you import, you have to pay duty at $3.5 minimum. So the actual value of the fabric is around that only, but they were dumping at very ridiculously low prices. So now the government has put a cap that you have to pay duty at $3.5 minimum or at what price you have imported, whichever is higher. So that is what they have done. And this is till September. After September, before September, I think the budget will come. So they will correct it in the budget. So this is a stopgap arrangement they have done. And as far as export is concerned, it's very difficult to compete in the export market with China because they have advantage of almost $70 in PTA, which amounts to around $60 per ton in the yarn. So wherever the freight portion is lower from India as compared to China, we are able to do it. But where the freights are similar, it's very difficult to export there. So once the new plants of PTA will come in, then this difference of $70 will go away. Then we will be able to compete with them. As far as local is concerned, domestic sales, yes, the margins have started improving slightly. And going forward after first quarter, I think it will improve more because in first quarter there is a lot of labor shortage. And the production side, fabric side, the productivity is also low, so the demand is low for the yarn. Even though in spite of all this, there is a very slight improvement in the margin. So first quarter, I can't say if we'll do something better than last year. But yes, going forward, as a year as a whole, we would significantly have better margins in the year. Umesh, is it okay? Anything else?
Yeah. Yeah. When I look at interest cost in our quarter 4, there has been a significant dip in interest cost. The interest cost has reduced to 3.2 crores versus 11 crore last quarter. Any reason for this decline?
Yeah, we have some ECBs and which are unhedged. So sometimes because of the currency loss, last quarter was more, and this year there was rather some currency gains, so that is why it's lower. The ECBs are in Europe. Because of that, it happens.
Sure. And lastly, on the capacity expansion, we have announced 70 ton capacity per day. What will be the capex for this capacity?
Yeah, capex has been around 42 crores.
42 crores. And this is expected to commercialize by when?
Yeah, this month only it will start off.
Okay. Okay. Thanks. That's it from my side.
Thank you.
Thank you. The next question is from the line of Basant Pandey, who is an individual investor. Please go ahead.
Good evening, sir. Hello.
Good evening.
Yeah. Sir, this is regarding our recycling plant expansion. If I remember correctly, your 30th October exchange filing, pegged the cost at 150 crores for a 20,000 metric ton per annum plant. And now it is, I think, a 26,000 metric ton per annum plant, and the cost is pegged at double, that is 300 crores. So any particular reason for this escalation in cost?
Yeah. See, first, when we had envisaged this project, we were thinking that we will be using PET bottles and yarn waste.
Mm-hmm.
But now, during the period, we have been able to develop a technology to use even the fabric waste, like very small cuttings of the fabric, so that we can convert to now the chips. So that is involving some more machinery, which is quite costly. That is why it is there. And the cost of the raw material at that stage previously used to be like 40-45 rupees a kg. It would now go down to 15 rupees a kg. So
that will offset the...
Also, we'll be able to use the color fabric now. Previously, we were not had the technology to use color fabric. Now we have developed and being successfully able to convert color fabric also back to the polyester. So that is why the cost has gone up, because some machines which we have used to do this are quite costly.
Okay, sir. Thank you for that clarification. Another thing, sir, we are going to invest 50 crores into Texfil, right? So that would be in the form of equity, I suppose?
Yeah, 50 crores at the moment we have taken from the board approval for equity, and up to 100 as a loan. And balance we will see, either we'll take bank loans, or if need be, if we have sufficient, maybe more will be invested by the company as we go forward. See, it's a very new project. It's one of its own kind. So it's very difficult to predict exact cost. This 300 is a very ballpark number. Plus minus can happen a little bit. So it's not a technology which is already established.
Right, sir. So another thing, the polyester chips, the recycled chips which we will be manufacturing, do we plan to convert them into yarn at the Dadra plant, or will be selling the chips?
No, first stage we will sell chips also, and we'll convert it to yarn at our Dahej or Dadra plant as per the requirement. And then we would also have the possibility to set up more yarn unit at the same location for converting it directly to yarn at the same location. So initially we don't want to put money in putting up yarn facility, because that we already have at a different location.
Right, sir. And any plans of tying up with any big global manufacturer for captive sale of yarn?
We are in talks with few brands for tying up. So we already are in talks with them.
Right, sir. Thank you very much, sir. That's all.
Thank you. Ladies and gentlemen, you may press star and 1 to ask a question. The next question is from the line of Pratik Bhandari from AART Ventures. Please go ahead.
Hi, sir. Good afternoon.
Good afternoon.
can you let me know as to the acquisition cost of this Texwell acquisition?
That's 20,000 rupees.
Sorry?
20,000.
20,000. Okay. And how do you see, the top line in the next financial year, FY25?
I think top line we should be doing maybe around 5 to 7% more than what we've done. Because we are not adding new capacity much. This new capacity which we are adding is only at the chip stage. So this will improve our margins. The cationic chips will not add much to the top line.
So the margins would be in the same range or they would improve?
No, the margins would be, as I said, this year we expect to have a 15 crore extra margin because of this new capacity.
Okay. 15 crores during the year?
Yes, during this year.
Okay. And that is out of the capex made for?
Capex is around 40-42 crores.
So what would be the capacity expansion, annual capacity expansion?
So annual would be around 25,000 tons.
25,000 tons. Hello?
Yes.
So out of 25,000 tons of capacity expansion, we are expecting 15 crores added up in our margins.
Correct.
Okay, thank you.
Thank you. Ladies and gentlemen, you may press star and 1 to ask a question. The next question is from the line of Gaurav Agrawal from 91 Capital. Please go ahead.
Hello, sir. Thank you for the opportunity. Sir, in terms of your EBITDA per metric ton, suppose, whatever you are expecting in the upcoming budget, that happens. So what kind of EBITDA margin or EBITDA per metric ton do you expect to do on a full year basis in FY25 and in FY26 maybe?
FY25 we expect our EBITDAs to improve by at least 40 to 50%.
Okay,
and then
40 to 50%.
Yes.
Okay, and the next year?
Next year, another 40% over and above the FY25.
Okay. So basically, the revenue is not growing that much as you just replied to the previous participant's question, which means our EBITDA margin should be, we should move from 6 to 9%, and then from 9 to, let's say, 13.5 to 14%. Is the understanding correct?
Yeah, approximately, yes.
Okay. And sir, what would, go wrong, in the industry or for yourself that you might miss this guidance? What would go wrong? Yeah.
Sorry, I couldn't get you properly.
No, I'm saying, sir, we are guiding for a very healthy, increase in margins. So obviously, we must be taking certain assumptions. So I just wanted to understand, what are those assumptions that you are currently taking to guide this kind of expansion?
Correct. So the main in the world, the total production of filament yarn is roughly 50 million tons.
Right.
And every year China was adding around 3 million tons, which for next 2 years China is not adding anything.
Okay.
So that will create a global demand, and China already in this year is over 92% capacity utilization.
Right.
Margins have to be improved to a level where new investment can come in. Unless there is a 13-14% return on percentage return on the turnover, it doesn't justify putting up new capacities. As I said, it takes around 1,500 to 1,600 crores to put up a capacity of 2 lakh tons.
Okay.
So if you don't get even 1,300 or 300 or 325 crores as EBITDA, nobody would put up a new capacity.
Right.
So it has to come to those levels. And in India also there is no big. There are only 2 plants which are coming up, which would add to around 9% of the capacity in next 2 years, whereas the demand is growing around 8 to 9% every year. So all these assumptions, because of these assumptions, I am saying that the margin will improve to those levels. And these will, even after this, they will come to a level where one can think of putting a new capacity. Before that, it's very difficult for anybody to put up a new capacity.
Understood. So, sir, as you said, to put a 2 lakh metric ton kind of capacity, it would entail, somebody to spend 1,500 to 1,600 CR. What's the capex turn here, sir? How, is it 1x or is it like 1.5x? What's the capex turn here, sir?
Turnover would be around 1.5x.
1.5x. Okay. So we expect 325 crore EBITDA on 14 and a half is what you are also guiding. Okay.
If you do around, say, 2,300 crores turnover, you need a EBITDA of at least 320 to justify a 1,500 crore investment. No?
Correct. Okay.
So based on that, I am giving you these numbers. That's also persons who are already in this business would think of putting it. A new person will not do it even at these numbers.
Right. And sir, how much time does it take, to add a brownfield line here, or for a greenfield? How does the time?
Minimum 2.5 years.
Okay, that is for the brownfield, is it?
No, for a greenfield.
Okay, and for brownfield, sir, if you were to add a line, sir?
6 months, like 18 to 24 months.
18 to 24 months. And is it because the machines that you import from outside, these vendors take a lot of time, or is it the environmental process that takes a lot of time? Which is that part which takes a lot of time here to put a new capex?
Everything, taking environmental clearances, land problem, then ordering the machine deliveries are 12 to 15 months, then making building, everything would take 18, 24 months.
Okay. And sir, if I may squeeze the last question, we are doing this recycled capex of 26,000 metric ton, and you said that it will be operational, let's say, by December 2025. On a full year basis, let's say FY26 is anyways, it will be only there for 1 quarter. So more specifically for FY27, what kind of revenue can one expect from there, and what kind of margins would we be envisaging over there?
See, the margins there, we are envisaging around 40% EBITDA.
Okay.
And the turnover in a full year would be around 275 to 80 crores. First year, maybe the capacity utilization, because it's a new thing, it could be around 60 to 70%. But if we take a full year, it will be 275 crores with a margin of 40% EBITDA. So 105 to 110 crores EBITDA.
On a total investment of 300 CR.
Correct.
Okay. That sounds a very high ROE, I think. Very, very high ROE opportunity.
Yeah, so I can give you one name like Loop Industries. They have given a investor presentation, and they are investing $400 million for a 70,000 tons plant. And they have given a guidance of 45% EBITDA. Even at $400 million for a 3-time plant, what we are thinking of. So they are putting 10 times the investment, 3 times the plant, and EBITDA of 45%.
Understood.
Search in Google Loop Industries, I'm giving the name.
Okay. And sir, this recycled product, will we sell it to the existing customers, or do we need to find a new set of customers for these?
We will make polyester chips, so either we will make the yarn ourselves or people who are making the yarn from chips.
Right. Understood. Okay, sir, great. Thank you so much for answering my questions patiently, and all the best for the next 2 years. I hope, we definitely get to see the margin recovery which needs to happen here.
So. Thank you so much.
Thank you. The next question is from the line of Ketan Athavale from Robo Capital. Please go ahead.
Hello, sir. Thank you for the opportunity. Sir, firstly, can you please reiterate your FY25 and 26 guidance?
FY25, full year, I think we should do 40 to 50% over this current year EBITDA. And then another 40%. So maybe around 9% EBITDA in FY25 and around 12.5%, 13% EBITDA in FY26.
Okay, and on revenue terms?
Yeah, on the revenue terms I'm saying. Revenue I don't think will be much improvement, only 5 to 6% in FY25. And 26 also not much improvement because we're not adding any additional capacity in these 2 years. So maybe another 5% in these 2 years.
Got it. And can you throw some more light on how are realizations currently in the industry and both domestic and export, and how do we see them in the coming quarters?
Right now, the realization is similar to Q3, Q4. But going forward, I see Q2, Q3, Q4 improvement would be there. I explained in my two others. Then this quarter, there is a lot of labor problem in India. This is all migrated labor, and because of elections and marriages, normally they migrate a lot, but elections have also added to that migration. So there is a lot of labor shortage all over. So the weaving industry, knitting industry reduces production. So there is not much scope to improve margins in this quarter. But yes, we can see the imports and other things going down from maybe mid-June to end June, the margins would start improving.
Okay, got it. Thank you. Thank you so much.
Thank you. The next question is from the line of Pradeep Rawat from Yogya Capital. Please go ahead.
Yeah. Good evening, sir, and thank you for the opportunity. I would like to know what is the sustainable margins that we can sustain in a normalized environment, and what we are doing or can we do in future to increase this normalized margin?
The normal margins, I would say, should range around 11 to 14%, depending on the market conditions. It cannot be stagnant. And we are trying to develop new products and improve the product range and make some niche products to improve our margins. That's what we do. Like we have put up this cationic, so this will start. This will help us in increasing some margin. So going forward, we will introduce some maybe new products to improve the margin, and we are going for this recycle that will enhance the margin. Of course, it is in a subsidiary of the company, but it will also get merged with the company, the financials.
Okay, that's all from my side.
Thank you.
Thank you. The next question is from the line of Sarvesh Gupta from Maximal Capital. Please go ahead.
Good afternoon, sir. Sir, on your margin guidance, so basically you are saying that we should revert to something like FY22 kind of margins in couple of years.
Yes.
But before that, let's say till FY20, our margins were always in the range of 7 to 8%. So what has structurally changed for us that we can say that going forward a higher margin will be new normal? Because if you look at the history, it looks like if you look at a long history of the company, it looks like FY21 and FY22 were aberration rather than your regular margin, and FY24 looks more like in line with your historical margins.
No. See, historically, China has been dominating this industry for the last 20 years. So people know that history only. Before that, there were huge margins which were undreamt of. People have made margins of like 40 rupees a kg also. So now China has stopped increasing production in this sector. So next 3 years, they have no plans to increase. And going forward, as per their labor is going down, I mean, the workforce is reducing. I don't think they would be investing more into textile. So that is why historically the margins were always lower. And last year also, what incremental production they have done is because of the investment they are already committed before the COVID, that only got materialized last year. Now going forward, they have no commitments of putting up new plants. As per my information from the machinery suppliers already cut down their production by 75-80% because there are no orders. So going forward, there will be shortage of, or there will be huge demand for these filament yarn because the new capacity is not coming up. And any improvement in textile is only happening through man-made fibers, and in man-made also, especially polyester filament yarn. So that is why I am basically saying that our margins will improve and will be on a sustainable level for a long time.
Understood, sir. And sir, it's like China, what we have heard is many of the industries which are highly polluting or highly energy intensive, so they have this tendency to sort of claw back on those industries. So any specific reason why you feel that this particular industry would not see much of a growth in China from export potential?
First of all, this is a very labor-intensive industry compared to other industries. And when your labor force is shrinking, then no country would like to invest in textile. And if you go to long history, like from England to Japan, Japan to Taiwan, Korea, these people were dominating the textile. But as they become developed in the countries, textile always goes away from these developed countries. So now China is going towards a developed country. So definitely textile will go down because they will not be able to afford to make textile. Otherwise, the labor cost on the product would be very high. So, but their internal consumption is so high, I'm not saying they will reduce, but at least there will be no new growth coming into China. So it is based on long time history of textile where it has moved from developed countries to developing countries. So now China going towards developed countries, it will definitely reduce textiles. And already signs are there. Their production is not increasing the way it was increasing in previous 10-15 years.
And given that, do you see any export potential opening up for the company as such? Because
it will open up, but right now China is selling at a low prices because their internal economy is not very good. So internal consumption is down. When it picks up, definitely they'll raise prices and we'll be able to compete and export more. But there will be local demand so much. Why do we need to export yarn? No, we can always export fabric or garments with more value addition. If the Indian manufacturers need to make fabric here and garment and then export that. So the overall export of textile will increase, not necessarily of yarn. It can increase in the form of fabric or garments.
Understood. And finally, sir, you gave this example of loop industries. So basically, they are investing 10x for just 3 times the capacity that we are in.
Their technology is different. They are converting. I just gave an example to give an idea that we are also not just totally out of line because this is a new industry and a new technology. People have no idea why this capex is there. So just to give you an idea that we are not out of line in what is happening in the world. It's not exactly the same technology. They have a different technology.
Understood. And apart from this, what is the capex for the next 2 years for us?
Not much has been planned. Maybe we'll add some more yarn capacity if we see the margin improving. So there could be a capex of another 150 crores in the main company.
How much?
To add more filament yarn lines or maybe go for more texturizing machines. But as on date, it is not on card. We will wait for 1 or 2 quarters and see how market behaves, then we will commit to that investment.
And our finance costs has fluctuated a lot. In fact, from last Q4 to this Q4, there has been a significant...
I already explained. It is because of ECBs in Europe which we have. So the mark to market which we have to do every quarter makes it fluctuation.
Sir, but going forward, how should we take it? Like, what should be the normalized interest cost for your...
Normalized interest cost on a yearly basis is not more than 7.5-8%. But quarter to quarter, it can fluctuate.
Understood, sir. Thank you, sir, and all the best.
Thank you.
Thank you. Ladies and gentlemen, you may press star and 1 to ask a question. A reminder to all participants that you may press star and 1 to ask a question. The next question is from the line of Ketan Athavale from Robo Capital. Please go ahead.
Thank you for the opportunity again. I just wanted to know on this PK raw material which we talked about, PTN. So when that comes up in India, do we expect all the $70 disadvantage to negate?
It's very difficult, but I think major amount would negate.
Okay, major. And can you please tell again by when this capacity is expected to develop in India?
See, 2.4 million would be operational by end of calendar year 2025, which is of Indian Oil and GAIL, because already these plants are in these later stages of getting.
Oh.
starting up, and Reliance has just started, so that we expect to complete by 2026 December. What information we have from these companies, that's what I am sharing with you.
Okay, got it. Thank you so much.
Ladies and gentlemen, you may press star and 1 to ask a question. A reminder to all participants that you may press star and 1 to ask a question. The next question is from the line of Gaurav Agrawal from 9-1 Capital. Please go ahead.
Thank you for the opportunity again, sir. Sir, wanted to understand the dynamics on the PTA side. So obviously this commodity is linked to crude oil. So, sir, suppose the crude oil prices jumps, how much time do we have, to pass on the prices to our customers? And also, in case they fall, how much time does it reflect in our financials?
Yeah, crude oil and PTA have a relationship, but it's not 1:1. Also, demand and supply makes a lot of difference. So some fluctuation in the prices is also because of demand and supply. And normally we are able to pass on if there is any increase in the raw material prices to our customers.
But sir, how much is the lag? Like, is it like a 1 month lag, or like we are able to pass it on in a 3 month period? Or is it like on order basis we are able to do it?
1 or 2 weeks, not more than that.
Okay. And so in terms of your...
Every week the local pricing changes based on whatever the international prices are. So we have a weekly raw material pricing from the supplier, and we are able to pass it on within 1 or 2 weeks. Okay, understood. And sir, any outlook on your debt? It is at 233 CR right now. How will it go in the next 2 years? And the previous participant asked your cost of debt. You refer to 7.5 to 8%. So this is the cost of debt you refer to, right? 7.5 to 8, including the hedging cost. Yeah. 7.5, 8 is including the hedging cost. 8%. Okay. And sir, this debt outlook, sir, will it go up from here because of the recycling plant we are intending to, or how is it? I don't think we will be taking any new debt, at least in FY25. FY26 maybe for the new recycling project, because there are certain government benefits which are linked to interest subsidy. So in case there is a good government interest subsidy, we might take loan in the new company. But in the main company, we don't plan to take loan as of now. Okay. Because, sir, in the next 2 years, I think we'll generate very substantial cash flow. And we don't intend to... But see, if there is an interest subsidy given by the government, so it's better to take loan and deploy it somewhere else. Yeah, definitely. I was asking more a bigger question, which is, next 2 years we'll generate substantial cash flow, and we don't intend to do much capex in the core standalone business. So where do we, what is the capital allocation go from there, because we'll generate quite substantial cash flow, around 450 crore kind of cash flow on a yearly basis. I will in subsequent quarter, as and when it comes, I will let you know what we'll do. Right now, I'm not made up what to do with it. Okay, sir. Thank you.
Thank you. Ladies and gentlemen, you may press star and 1 to ask a question. A reminder to all participants that you may press star and 1 to ask questions. The next question is from the line of Raj from Arjav Partners. Please go ahead.
Am I audible?
Yes.
I just have a doubt on the expansion plan of the company. So you are going to spend around 300 crores for an additional capacity of 25,000 tons. Is it right?
Yeah, 26,000 tons.
Acha. And you will have an EBITDA from this approx 40%, you said.
Yeah, so it will be in a first year it will be lower, but second year, full year of running, we should have a bit of around 105, 110 crores.
All right. And this capex amount, last time it was around 150 crores, and it is revised to 300 crores.
I think I already explained to one of the participants why it has gone up in detail.
Actually, put the point on that.
Yeah, so it is because that we have changed the raw material. We were first planning to do it from polyester waste of yarn or PET bottles. Now we have moved to fabric waste, which is much cheaper, and that is the demand of the brands that we should do textile to textile. So now we'll be actually using fabric waste, colored as well as non-colored, and converting back to polyester. So there is the equipment which we need to put, more costly equipment. That's why the investment has gone up.
Understood. All right, sir. Thanks. Have a good day.
Thanks.
Thank you. The next question is from the line of Yash Malhotra from JM Mutual Fund. Please go ahead.
Yeah, hi sir. I was just looking at your cash conversion cycle. You seem to be doing pretty well. Do you think if we sacrifice some of that and go back to our previous levels of 30 odd days, we can help improve our margins?
I don't think it's possible because 4-5 days we can, right now our total cycle is around 45 days. Okay. And our debtors are hardly 10-12 days. To reduce debtors more than that is very difficult. And we have a lot of imports of raw materials since it is not available in India. So you have to keep a little higher raw material inventory. And
no,
finished product depends on the market situation. So normally our finished products are around 10-12 days, but at the moment we are, I think, 15-17 days. So that's why it's very difficult to reduce less than this.
That's correct. I'm not asking you to reduce. I'm asking you to sacrifice it even more. So if you were to...
What should I sacrifice? Tell me.
Lend your product on credit per se. Do you think
No. I don't want to do that because it can lead to a lot of bad debts.
All right.
They are not secured credits.
Correct. Okay, sir. Yes.
Thank you. Ladies and gentlemen, you may press star and 1 to ask a question. A reminder to all participants that you may press star and 1 to ask questions. As there are no further questions, I would now like to hand the conference over to Mr. Madhusudan Bhageria for closing comments.
I thank all the participants for sparing their time and joining us, and we hope to meet again in July for the first Q1 FY25 conference call. Thank you very much for sparing your time.
On behalf of Filatex India Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your line.